Welcome back to the Tradeciety's Traders Improve podcast, and today we're talking about the trifecta of profitable trading. And we're going to take a look at the three most important components of profitable trading. We learn how to set up your trading strategy for long-term success, and we discover how to start thinking in terms of probabilities and how to get into the probabilistic mindset. The first part of the trifecta is the reward to risk ratio. And the reward to risk ratio is the relationship between the size of your winning trades and the losing trades. So let's take a look at an example. If you risk $100 to make $200, your reward to risk ratio is 2-to-1, and your winners are twice the size of your losses. Generally speaking, the higher the reward to risk ratio, the better it is for your trading overall. But it's not as simple and straightforward. Because if you are trying to catch large winning trades with every single trade that you're taking, it often comes at the expense of your win rate. Just pull up a chart and you will see that on any given day or on any given week, the price will not give you long trends and will not provide large winning opportunities every single day. And this means that a trader who regularly tries to catch large winners will naturally see a drop in his win rate. Of course, every now and then you will be able to catch a large winning trade, but if you swing for the fences and if you want to try to hit a home run in every single trade, what you will see is that there's a drop in your win rate, you will have a lot of losses, and you will also have a lot of break-even trades. And therefore, what I have seen, not only in my trading, but also when working with other traders, is that on average, especially in the beginning, most traders will do much better if they're going for a more conservative reward to risk ratio, at least in the beginning. I already mentioned that there is a connection between the reward to risk ratio and the win rate, but it goes much deeper, and let's explore this now. When you have an average reward to risk ratio of 2-to-1, it means that your winners are twice the size as your losses. And this means that you could take 2 losses for every winning trade and you will still end up break even. So here's an example. With a 2-to-1 reward to risk ratio, you make $200 on a winning trade and you lose $100 on a losing trade. And let's say out of your next 6 trades, you have 2 winners giving you $400 in profit, and there are 4 losses and you will lose $400 on those 4 losses. So you win $400 on 2 wins and you lose $400 on the 4 losses. And that's going to break even, of course. So with a win rate of 2-to-1, you can trade break even with a win rate of 33. And if you have a win rate that is higher than 33%, you will make money no matter what. But there's a little catch, as we will see in the later part of this video. Now let's assume instead of a 33% win rate, we have a 50% win rate. So we have 3 wins and we have 3 losses out of our next 6 trades. What happens now? So you make $200 on each win and you lose $100 on each loss. So on those 3 wins, you make a profit of $600, and on those 3 losses, you lose $300. So 600 minus 300 gives you a profit of 300. So the further you move up from the 33% win rate, the more profits you will make. At least you need a win rate of 33% with a 2-to-1 reward to risk ratio, and the higher your win rate or the higher reward to risk ratio, the more profits you will end up making. And you can calculate that for any reward to risk ratio or win rate. What is the break-even point? I will put a link in the video and the podcast description to one of our articles where I describe how to calculate the break-even point. But let's keep talking about the win rate a little bit more. And we will see that there is something that a lot of traders overlook and struggle with. Now let's assume we have 20 trades and 10 of them are winners, which is a win rate of 50%. Generally, traders believe that the higher the win rate, the better. But there's way more to successful trading than just a high win rate. And when you look at the professional traders, you will see that most of them have a win rate of around 50%. And many of the best traders even have a win rate of much lower than 50%. And what you will see when you read the market wizards or listen to podcasts with the best traders, you will see that those professionals, they don't focus on the win rate at all because they understand that the win rate is not where they need to put their attention to. And they also understand that they don't even need a high win rate. They don't need to be right often to make money. Only amateur traders are constantly chasing high win rate system. But this is a losing mindset and a big problem that costs most amateur traders their whole trading career before it even gets started. Trying to avoid losses is a recipe for disaster, and traders who expect not to lose will not be able to handle losses mentally. They will freak out after the first loss or the first string of losses. And what happens when a trader cannot take losses? And I've come up with 4 common ways in which the inability to take losses will wreck your trading. First, traders who cannot take losses delay loss taking, which means not using a stop loss or moving your stop loss further away as the price keeps going against them. And then a small loss will turn into a big loss. 2, the traders will add to a losing trade and they hope to turn a loss into a potential break even or maybe even a profitable trade quicker when the market and the price turns around. But as we all know, the price will not always turn around. And as you keep adding to a losing position, the loss will just become larger and larger and larger. The third point is that a lot of traders, after taking a loss, will jump right back into a new trade. And this is what we call revenge trading, when you trade after a loss without having this chart give you proper entry signals again to take a trade actually. And the fourth point is that those traders after a loss or after a few losses, they will start looking for new trading systems. And this is what we call system hopping. They will give up on their old system way too early without having put in the time, without really evaluating and exploring the possibilities and the effectiveness. And they start chasing a new holy grail system, which will not lose, or so they hope. If you do any one of those 4 things, this is a clear sign that you cannot take losses properly. And you have to work on this with a high priority, because a trader who cannot take losses cannot trade profitably. The sooner you learn how to take losses, the faster you can become a profitable trader. We already did look at the connection between the win rate and the reward to risk ratio, but there's one thing a lot of traders overlook. A high reward to risk ratio and a high win rate is obviously the best combination for a trading strategy. But as we have seen previously, it is not necessary to have a high win rate to make money. You can trade very profitably with a win rate of 50% and a reward to risk ratio of around 2 to 1. And as we've also seen, shooting for a high reward to risk ratio will usually come at the expense of your win rate. And even more importantly, trying to achieve a high win rate will often lead to emotional issues. But did you know that even with a high win rate and a large reward to risk ratio, you could still lose money? Now you might be wondering, how is this possible? Because I just told you that a high reward to risk ratio and a high win rate together will make you money. And this is where risk management and position sizing comes in. And this is the third component of the trifecta of profitable trading. When you leave your risk unmonitored, when you don't have risk management practices and principles in place, you could have just 1 or 2 or a few losses that get out of hand and that wipe out your whole profits of the last day, the last week, or the last month. So without proper risk management, a few losses often lead to account margin calls or at least major drawdowns. And that is why managing your risk is so important. You can have the best system in the world, but if you don't manage your risk, you will end up broke sooner or later. In most cases, sooner. You need to make sure that you have some kind of position sizing strategy in place. It could be as simple as risking 1 or 2% on each of your trades. This is already a very good starting place. And what it does, it makes sure that no single one trade can cause large damage to your trading account and to your mental capital. Avoiding single large losses is so critical. And having a steady position sizing strategy will make sure that you don't have any one large outliers in your performance. Outliers are not only dangerous for your trading account, but also for your mental capital. And recovering from a loss of mental capital is often much harder than recovering from a financial loss. If you can avoid single large losses, you have already made a huge step forward in your trading. So make sure that you have a steady position sizing strategy in place, and this is the #1 priority right now for most traders, and it's an absolute requirement for profitable trading. As a summary, we can say, first, you cannot win every trade, and therefore you need to make sure that you can take losses effectively. 2, you don't need to have an exceptionally high reward to risk ratio, and you don't need to shoot for the home run in every single trade. 3, you need to stop obsessing about your win rate. The win rate is arguably the least important part of your trading. And finally, make sure you have a proper position sizing strategy in place so that you can avoid single large losses.